Okay.
All right.
Hi, everyone. I am Megan with Sidekick Accounting and your accounting sidekick, and I am so pleased to introduce you to Julie Coppersmith. She is with Thrivent Financial, and she is here to share some important information about retirement and succession planning, because those are some topics that people don't talk about or think about as they're operating their business in the day-to-day, but can be really, really important for the future of you as an individual and your business. So why don't we get into it? And Julie, do you want to introduce yourself first before we get into the questions a little bit more?
Sure. Yes, absolutely. So
Thank
I'm
you.
Julie Coppersmith, and I'm a financial rep with Thrivent. At Thrivent, we believe that life is better when it has a purpose. So we see money as a tool and not a goal. So I provide holistic financial services to help you live your best life possible.
Cool. Thank you.
You're welcome.
We are pleased to have you. So it's February of 2021. It's been a crazy year. It's been almost a year since we had the pandemic happen and touched the United States and shut everything down and make us all crazy. And I know one question that a lot of people have is, taxes this year. There's a lot of concern and, thoughtfulness, I think, put into taxes and their accounting more than probably in previous years, because a lot of issues came up with their numbers, business owners and their numbers and their taxes with this year and all the things that the pandemic happened. So right now we're into 2021, so 2020 closed, but is there any retirement options people still have for their 2020 taxes that they can still implement right now in the beginning of 2021?
Well, if you don't have a retirement plan in place, you have until April 15th to set something up for 2020 and make the contribution. That can be either a business plan or an individual plan. So whether you're looking at a simple plan, a SEP plan, an individual IRA, or an individual Roth, you have until April 15th to fund that and count it towards 2020.
Sorry, my cat. Cool. Thank you. Yeah, for that. So in terms of what those are all IRA plans, and they're obviously different IRA plans. Could you break down a little bit what each individual IRA plan looks like, just from a high level, and what those contribution amounts look like as well?
Sure. So a simple plan is a small business plan where you're allowed to have up to 100 employees participate. There's two different ways that you can do your match. The first one is to have a 2% contribution to anyone who qualifies to be in the plan. So what that means is if you lay out your criteria that they have to work there 2 years and they need to have earned $2,000 in each of those years to qualify, as soon as they reach that point, you begin to put 2% into their plan, whether they are participating or not. The second option is to do a dollar for dollar match up to 3% for those who participate. So the difference in this one is that the employee actually has to participate in this side of it. The great thing about a simple plan is that the employee actually owns their retirement money. So as soon as you put it in, that your portion of the contribution, that money is theirs. There's no vesting schedule at all. There's no rollover paperwork if they leave. If they leave, it's just theirs. Now, any type of retirement plan has penalties if you take money out before age 59 and a half. So IRA, a SEP, or 401k, an IRA, a Roth, money that comes out before 59 and a half is subject to a 10% IRS penalty. A simple plan has a different rule, though, that's unique in the fact that if the individual's plan, now not the whole company plan, but an individual has it less than 2 years, that 10% increases up to 25%. So that's something a person has to be aware of when they're making contributions, is that they're not putting themselves in a cash-strapped situation. The employee can contribute up to $13,500. Plus, if you're over age 50, there's a $3,000 catch up. So an employee could literally earn $16,500 and put 100% of their money into this plan and virtually have a zero income for the year. The employer's only obligated to contribute up to that 3% match. So don't think that your number is going to get that high. In a SEP plan, that's actually a pension plan. So only the employer contributes to it. No employee contributions go in at all. The limits on that are 25% of a person's income up to $58,000, whatever is less. So this is usually something that works well where the owner is a very high income earner and your employees are obviously making much less. It works very well for like independent dental offices, things like that. And the reason why I say that is because when you set that contribution amount, it's across the board to anyone who qualifies. So the maximum criteria that you can set is that the person has to be at least 21. They have had to have worked 3 of the last 5 years and made $650 for the last 3 years. So you can make it kind of complicated, but you also can eliminate a lot of the high turnover positions by doing that. But remember, you have to give that same percentage to everybody. So let's say you want to try to max out what you can put in and you say, oh, I want to put in 25% of my income. You have to have enough to do that same thing for each one of the employees that is in the plan. The last one is a 401k plan, and we do offer those through John Hancock. The difference with a 401k is that the employee has the ability to do either pre-tax or after-tax contributions. Those aren't available in the previous 2 I mentioned. They are more costly and they do have higher oversight. So it is a commitment by the employer to start a plan like that. I say if you're smaller, choose one of the simpler plans. Other ways to save are through individual IRAs and through also Roth contributions. Now I am going to go back quick to the simple and the 401k. Let's say you're someone that has a regular full-time job and you have a part-time job, and one offers the 401k and one offers the simple plan. The IRS does keep your contribution limits to $18,000 max combined. So you can either put all of it into the 401k, you can put the $13,500 in the simple, and then do the difference into the 401k, but there is a max. On the individual IRAs and Roths, you are limited to $6,500, and you do have the ability to do catch up. So there's lots of ways to save. Now, some people actually max out their plans and then they're looking for alternative methods to save. If you are looking for some tax deferred options, I have those available as well.
Okay, cool. And those would be for the 2020 tax year or the 2021 tax year?
2020. The 401ks, you are limited to a year contribution. So if you did not contribute before December 31st,
okay,
you're starting in the 2021 year.
Got it. Okay, that's really helpful. General. So you kind of touched on the difference between the self-employed and then businesses with employees. Now with the SEP IRA, you said that that was something you do or that your employer contributes to, but you can actually contribute to that when you're self-employed, just yourself as well, right?
Yes, you can. You can open that up as a sole proprietor, the same with a simple.
Okay.
The nice thing about the SEP plan is that the limits that you can put into are significantly higher.
Okay, as a self-employed individual.
Yes.
Okay. So that's a great option for people too, especially if they want to be a little more aggressive with their retirement planning. So,
Absolutely.
okay. So if, I know you've touched on this a little bit, but just to clarify, if I was a business with employees and I was looking to add on a retirement benefit as part of their benefit package, what would be the best option for a business just kind of starting to offer retirement options? Is there one versus the other that's better? Or does it depend on their goals? What do they need to kind of think about when choosing that option?
Well, I think it depends on if you're a high turnover industry. So, in a previous career, I actually worked for a large entertainment business, and the turnover was very, very high. So, we started a simple plan that we used the maximum that the IRS allowed for criteria for being able to participate, and that eliminated the bulk of the people that were only working 15, 20 hours a week, which saved on a lot of paperwork because it would have just been a nightmare with about 75 employees coming and going to maintain that. So what it did is it eliminated most of them and brought it down to either the very long-term employees or the employees who were in management level.
Okay.
So the other piece with a simple plan, if you're doing the one where it's a match based on participation, you have the ability to change that match from anywhere between 1% and 3%. So if you have a down year, you can drop that contribution rate down to 1%. You're just not allowed to do it 2 years in a row.
Okay. Well, that's good. That offers some flexibility for the ebbs and flows of small business. So that's
Absolutely.
that's a great option. Okay, great. Well, did you have anything else you wanted to add on the retirement side? Otherwise, we can jump into the succession planning.
No, I think that once you get beyond that point, it starts to be a little bit more individualized.
Yeah. Okay. Sounds good. Okay, so with succession planning, I mean, that term might be a little bit foreign to some people, or maybe they've heard it but aren't really sure. So could you just take a second to define what succession planning is?
Absolutely. So this is where you make the decision that you want to step away from your business, whether you have decided that you just don't want to do it anymore and you want to put it for sale, or maybe you have reached the point of retirement and you want to have a family member or a partner take over. So this is the structure that you put in place that where you set the parameters. You say this is what it is going to cost, and this is what you're going to have to come up with, and this is the payment plan. However, it is that you choose to structure it.
Okay. So how does somebody go about getting those pieces in place?
Well, if you don't have one in place right now, I would ask you this. If you were to die tomorrow and you had a partner, what is your family going to receive? Because I have spoke to people that don't have plans and they say, well, they'll get half of the balance in the checkbook. Well, that's not really a good plan, and it doesn't make the family very happy. So it's really important that as a business, you actually set up a plan that is designed to lay that out specifically. So let's say you're a partnership and it's you and two other people. Right from the get-go, you determine if one of us leaves, what is it going to cost the other two? Now, leaving can be in different ways. Like I said, it could be that you want to sell your portion or you want to maybe have a family member take over. But what if you pass away? So if you don't have a plan in place, or let's say you do talk about a specific price, how do you come up with that money? So the buy-sell agreement is what defines all of that. And that is actually a legal document that is drawn up by an attorney, and it lays out exactly what needs to take place in those occurs.
Okay.
So when we're thinking about uh, just your current your current situation, make sure you have that buy-sell agreement in place. There's different ways to fund how that money will be paid out. If your business is in a good place, you might be able to go to the bank and get a loan. You could set up a sinking fund where every year you're putting a little bit of money aside so that when that eventually takes place, the money is there. But what a lot of people do is they will think about the business taking out life insurance policies on each of the owners. And that way, if something unexpected would occur, they instantly have the money available in order to buy out that partner and take care of the family.
Okay, that makes a lot of sense. So it's something that's really important for businesses to think about, especially once they reach a certain point, right? Or is this something that any business, regardless of how they're structured and operating, should be considering at this level?
Well, I think it's really important to think about it any level. And the reason is, what if your family is dependent on your income? So let's say you're just a painting company and you're providing 70% of the household income, and you're just a sole proprietor, like I said, if you pass away, the business ends. So where does income come for the family? So having that in place is so important to make sure that when a tragedy occurs, it doesn't start a snowball effect of more unfortunate things occurring.
Sure. That makes a lot of sense. Yeah. And the benefit is that with like a life insurance policy as a key employee or sole proprietor, that's something that typically can be run through the business as an expense. So the benefits from that way, or the business benefits from it that way as well.
Yes, what I would tell you is this is one expense you don't necessarily want the business to write off, because if the business inherits the money, that can become a tax nightmare. So there's a lot to think about in that situation.
Right. Yeah. Whoever's paying for it, right, gets the benefit, which is why
Exactly.
usually you want to have the life insurance policy on the personal side, and then they have key man insurance on the employee to benefit the business in the event they have
Correct.
to hire somebody. So that's great to point that out for people who might have that question, for sure.
Right.
Okay, so very cool. I think that was a lot of really helpful information. Is there anything else you want to add in terms of the succession planning and things
Yeah,
that business owners should be thinking about when it comes to that?
yes. So I work with a team of members, and one of them happens to be a certified exit strategy planner, because there's a lot to think about when this is going to occur. Because for most businesses, their business is the retirement plan. You put everything into it, not just your heart and soul, but probably a bulk of your money. So some people have the attitude, well, I'll sell my business and this is my retirement plan and this is how I'm going to live. But if it's not structured correctly, it can become a tax nightmare. So there are really some awesome tools available for people to help create some unique ways to help fund a succession plan, because you do have to remember that you can't sell it to your child for $1. The IRS requires you to do it at arm's length, which means you have to sell it for whatever you would sell it to anybody else. So if you own $1 million business, how is your child going to buy you out with $1 million? So those are all things that we're able to help you with.
That's great. Yeah, and it's good to know about these resources and have people who are experts, because it's a lot of information and a lot of pieces to think about and consider. So that was really great information. Thank you.
You're
Um,
welcome.
is there anything else you wanted to share with us?
Well, I do help both businesses and individuals. So certainly if you feel comfortable with what you already have in place as a business, but you have some concerns on the personal side or vice versa, I'd be happy to talk to you. There are lots of things that we think about when we are looking at not just planning for retirement, but also for your estate strategy. I also would like to mention there's a couple deductions that a lot of times people are very unaware of that they could be utilizing. Businesses can carry long-term care insurance. So if you're looking for a deduction and you have a concern along that line, you can certainly consider that. Also, if you have not thought about disability insurance and you think you are covered because you have workman's comp does not protect your income in the event that you become ill or injured. Illnesses can be anything from cancer to an injury that is prolonged. And we have the ability to write individual plans, or we can supplement a current business plan to protect up to 75% of your income.
Okay. Yeah, that's really helpful too. Is COVID included in the illnesses?
Yes, it is.
There's other tax benefits too if you have people or employees out with COVID related things right now. So, but I'm sure that'll probably phase out at some point.
Yes, yes.
So this is good information to kind of consider all the way around. And disability is one of those things that you can also offer as an employee benefit for your
Yeah.
employees also. So that is some great information. Well, thank you so much for sharing all of this information. How can people get in contact with you if they want to follow up on getting their personal or business or both situations kind of audited or dig into that exit strategy and succession planning?
Okay, you can call me directly at 920-965-9090, extension 7. Or if you prefer to email me, it is julie.coppersmith. My last name is spelled Coppersmith at Thrivent.com, and Thrivent is spelled Thrivent.
Thank you. Yeah, and her name should be in the window as well. So Julie Coppersmith. So for people to reference, hopefully
Okay.
everybody can see that. Okay, well, thank you so much for joining me today and to talk about these items. We really appreciate you sharing this valuable information.
Thank you so much, Megan.
Thanks. Talk to you later.
Sounds good.